Welcome to this video lesson on seasonal event-driven trading strategies. After completing this video, you will be able to explain seasonal or calendar trading strategies and list its examples. What is a seasonal or calendar trading strategy? It's a trading strategy which systematically exploits patterns in financial markets which are dependent on specific calendar dates. It may be an event which occurs on precisely the same day in a month. It could even happen in a month in a year, or even the same hour in the day. These events may occur often, or only a few times during the year. Human life is full of periodical events. Nearly everybody gets up from the bed at the morning, goes to work or school, goes shopping, etc. Part of daily life is random, but a significant part is scheduled. It's the same on financial markets, and seasonal or calendar anomalies try to capture profit from such repetitive events. One of the first documented seasonal strategies is the so-called Halloween effect. It is also called the sell in May strategy. This strategy is based on the historical underperformance of stocks in the summer months. This is the 6-month period starting in May and ending in October. This underperformance is in comparison to the wintry 6-month period from November to April. In this strategy, you sell your equity holdings in May, or at least, the late spring. You will then wait, and invest again in October or November, or the mid-autumn. This strategy probably originated in Great Britain. In earlier times, the traders, salesmen, analysts, etc. left London for a summer vacation, and returned in September. The advantage of this strategy is that since the event is scheduled, we can prepare for it beforehand. We can do our analysis before the event happens and then set up our position. It greatly simplifies the strategy execution. If the event is repetitive, then we have a long history of event dates and price reactions. We can systematically backtest trading strategy based on past events. But, what are these scheduled events, which we can base our trading on? There are many repetitive events that have a significant impact on market prices. It can be various periodic economic announcements, public events, holidays, elections, etc. It could also be events of the more technical nature, expirations of options, rebalancing of indexes, etc.